Guys, Raymond here with another financial statement analysis video. In this video, we're going to be analyzing a stock called Dutch Post, and this is, I believe, episode 5. Let me just double check. So we've done Airbus, so that's 1, 2, 3, 4, 5. So this is going to be episode 6 in our financial statement analysis for the German industrial stocks. We still have 47 in total that we're going to be analyzing. And if you're new to my financial statement analysis videos, what we do in these videos are we analyze the top 3 financial statements that are relevant to a company, those being the income statement, the balance sheet, and the cash flow statements, and we pick out the key factors of each statement, and we attempt to draw up a picture of the financial strength of the company, and we try to plan or at least come up with an idea of how the company will perform in the future, whether it will perform well or whether it will perform poorly. So without further ado, let's get into the key ratios of Dutch Post, and then we can move on to the financial statements. So the market cap, which is the overall price of the company, the value of the company according to the shareholders and the general market, is 48.2 billion euros, which is amazing. I love big companies. The P ratio, which is the price to earnings ratio, which depicts the overall priciness of the company, determined by how many years roughly it will take to get a return of capital. So if you invested $1,000, 1,000 euros in this case, it will take 9.68 years on average if the company maintained its economic output, and if the company's share price grew at a steady rate or at the same rate adjusted for inflation, it'll take you about 9.68 years to get a return on investment. So the revenue figure, which is the overall sales of the company, is about twice as much as the overall price of the company. Of course, we're going to need to check the market fluctuations and how the company's performed over the past year, as well as the overall profit that the company's managed to generate as a ratio to the overall sales, because the revenue figure is just sales and that's just how much the company sold, but the profit margin depicts how much the company's actually retained or how much the company's managed to generate outside of the costs that the company had to undergo to be able to generate the revenue. So the earnings per share is the amount of net income that the company generated per share of the companies that the company has outstanding, which was 4.02 euros. The dividend yield is the amount of cash that the company paid to shareholders as a ratio to the share price, which was 4.63%, which is just a little bit less than what we would say the minimum level is at 5% to classify the stock as a dividend stock. So it's not quite a dividend stock. The beta level is the overall risk level or the volatility level of the stock in the past financial year, which was 1.02. The average beta level is around 1, so it's doing really well. It's only 2% above the market average. So let's start off with the income statement as the first financial statement that we look at. The total revenue, as we saw earlier, was 81.7 billion euros in the 2021 financial year, and the company ended up with, let's just see how much the net income the company ended up with. So the net income before taxes was 7.36 billion euros, which is really good. That's about 10%. And the net income after taxes was 5.42 billion euros, which is still very good, just over 5%, which is really good. It maintained its revenue figure, actually increased it by a slight amount in the 2020 financial year, as well as the net income. So let's just check how it done in the 2020 financial year with regards to net income. So in regards to total revenue, made 66 billion euros. So there's definitely an earnings growth there's definitely a revenue growth in the 2021 financial year. And net income before taxes was 4.17 billion euros, and net income after the taxes was 3.18 billion euros. So there's definitely a clear growth in the between each 3 financial years. So let's get into the balance sheet, which depicts the amount of liabilities that the company has on hand, as well as the amount of assets that the company has on hand. So the light purple figure is the total assets, and the dark purple figure is the total liabilities. So the total assets of the company is definitely very high, just under 63 billion euros in the 2021 financial year. So it's managed to increase its total assets consistently over the past 3 years, as well as its liabilities. So I would say it's definitely the same ratio or similar ratio. I believe the 2020 financial year, it had it was a little bit more leveraged than in the other two financial years. But the 2021 financial year was its best year with regards to debt to equity ratio. I believe it's still quite high, but it's around 75% debt to asset ratio, which is not the best, I would say. It could do a bit more to improve that. But we're going to look at the cash flow statement to see if it's how well it's doing with regards to managing its debt. So the cash flow statement, we always look into more detail to see how the company is managing its debt and how it's managing its cash, and whether or not it's paying out any to shareholders, and if not, what it's doing with it. So the net income is the starting line of the cash flow statement, which was 2.78 billion euros in the 2019 financial year. In the 2020 financial year, it was 5.42 billion euros, and in the 2020 financial year, it was 3.18 billion euros. So there's clearly an earnings growth there from each financial year. And the cash flow from operating activities was 9.99 billion euros, which is really good. Cash flow from from investing activities was negative 4.82 billion euros. We kind of expect it to be negative because it shows how the company is spending its cash. So 3.74 billion euros of that was spent on capital expenditures, so expanding property, plant and equipment, and the other 1.09 billion euros was spent on other investing cash flows. And lastly, the cash flow from financing activities was negative 6.22 billion euros. 680 million euros went to financing cash flow items, and 1.67 billion euros went to dividends paid to shareholders. The other 3.88 billion euros went to buying back stock, which is really good. It shows the company believes in its operations and its reputation, and so it's buying back stock. And the other 2.76 billion euros went to, the 2.76 billion euros out of the 3.88 billion euros went to retiring debt. So it went to paying off debt. So that's why we saw the liabilities figure fall there. So overall, the net change of cash was 951 million euros negative, but we've seen the reason why it's negative. So it's not necessarily a bad thing. But without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.